No.
Hey, greetings, everyone. Thank you so much for attending. Thank you so much, David and Anka, for coordinating this synergy trading event. I am wanting to talk about commodities because it has been a theme near and dear for the past year. So I actually started a mantra last July of 2020 entitled Things Over Paper. And it was my way of transitioning into this new regime of higher commodities as well as higher yields and lower bonds. So I had a macro take that we were going to have a strong rotation into commodities and basically things over paper. And I want to show you kind of how that set up. I use basically macro as a backdrop, but technicals to test everything. So I'm going to kind of go over what I saw, what I was communicating with clients, and obviously where we've gone since and where we're potentially going. So first and foremost, my name is Samantha LaDuc. I am founder of LaDucTrading.com. I run a macro to micro advisory and options trade education service. I have several products that you can find at my LaDucTrading.com website, which is not only encompassing trader education in the form of a live trading room, but also I have risk indicators and very hip Discord server with lots of younger momentum based traders who are excited about the market momentum. I do a lot more of the swing and trend trading in my main fishing club business for both retail and institutional. So I'm coming to you from a background of macro, and then I am testing it against and testing it against and testing it against technicals. So with that, a little bit of background on me that I have been doing this since 2008 and full time, and I have been a contributor on national media, Bloomberg, CNBC, and such, which has been very helpful to kind of better understanding what clients expect. In other words, a lot of folks who are into fixed income and longer duration trends are interested in Bloomberg, but definitely there's a young crowd that has joined and they're very much focused in day trading and options. I do all of it, so it's my background to really kind of serve both masters. I love to, which is why I'm on as well, Benzinga and stock charts and the rest. So I just basically love to analyze. I love to educate and share my passion for trading, market moving news, and then of course my kind of distinct style of pattern recognition that allows me to kind of combine this macro narrative and try and figure out what the story, how the story will unfold using a lot of data, but also just a lot of common sense. And that's another reason why I felt very firmly that the transition into real assets was going to be very important after the COVID crash of last year. So, kind of moving on, this is my backdrop and my very big mode of operation is to look for trends and then trade around them and basically alert clients when volatility is entering the market. Because that's really the whole point of analysis, in my opinion, is finding the sector rotations and staying with them. So whether it be commodities, right now we have an energy crisis that's hitting China and Europe. And last year there was all the rage with electrification of vehicles, so EV was the thing. Anyway, the point is whether you're into high tech momentum trades, they're really bond trades, very interest rate sensitive, or if you're looking for more value, then you're looking for stuff that might be supported by infrastructure because of policies eventually coming down in DC. So the point is looking for whatever is getting a lot of institutional sponsorship, aka money, or the whales that also come through in big trades, whether it be options or in dark pools. I'm scanning it all. So, and looking for volatility for sure. So my type of trading primarily is discretionary. And that's what I do every day in my live trading room. I post it, chase, swing, and trend time frames, all my macro, all my intermarket in a client Slack workspace. So just so you kind of understand what I'm going to be showing you is charts that I have developed that are kind of my particular flavor, my intermarket analysis, but that I'm also sharing in a Slack workspace for clients, which of course is time stamped, and there's some engagement in there as well. So the result is a lot of assets are covered, and I'm talking, I go across all the assets. Oops, I want to go the other way. All the asset classes. So last year, let me just kind of actually flip ahead to that real quick. Things over paper was my theme and recommended to clients back in July of 2020. I did a big newsletter on that. That was important because I really saw that this was going to be the move, and the move was not just to replace stocks that were high flying. No. I actually made the case that we would still have a market advance, but that I saw the multi-decade lows in commodities would find a bottom and start to move higher, especially after the big oil negative print in May of last year and the COVID crash and lockdowns and all that. So this is kind of a chart, a ratio chart to, I hope, graphically display what the heck I'm talking about. So if you kind of look at this, this is SPX. It's a ratio to CRB. Okay, CRB is a commodity index that is managed by Reuters and Jefferies, and you can kind of see from the 90s all the way to today, we had a very, very strong impulse, as you already know, in our equity market from the 2009 low, after kind of QE, and they kind of figured out that whole thing. We just have been really firmly higher in equities relative to commodities, no question. When we got up here, which was a spike, okay, just on that spike, I basically said, I think we're going to have that come down, and commodities, relatively speaking, are going to start to outperform. So that was in July, and then I foretold basically that we'd have a rate spike that would kick in. It happened in August, so very soon after. Let me just kind of share that with you. So here's literally what I printed, July of 2020. I said the upside catalyst for equity markets advance, which we've had, right? No question. Insider buying where it matters is just some, large institutional stuff. What inflation looks like, because it was coming. I was definitely looking up and have tracked every economic data print from higher housing. I've interviewed housing data analysts and the like who were extremely bowled up about housing back in January, like long before the current data was released, that said, year over year rent increases, year over year housing increases, right? It's unaffordable for a lot of lower income wage earners. So the point was, all of that was pulled forward. In fact, my housing data analyst said it was pulled forward 5 years into 2 years. We had the strong demographics of millennials, we had the low interest rates, and we also had tons and tons of QE and Fed money flooding the system. So it literally pulled forward all that demand, which was going to increase this inflationary backdrop that I saw coming, and I saw an interest rate hike coming. So all that happened, long story short. In fact, this is the 10-year yield on a weekly time frame. You can kind of see this little note that I posted. I started writing about this paper to things rotation in July of 2020, but it wasn't until August when I said, we're done going down. So in fact, August 11th, I had made a loud call for a short in gold and a short in bonds, and we have continued to go lower in gold and bonds. So gold is part of precious metals. This is separate from, industrial metals, separate from the raw materials that we use in housing. But I'm just kind of showing you how the macro is a thesis, but then I have to test it out with all my technical analysis. So anyway, July, I think we're going from paper to things, and I showed you that kind of outlier event right here. And this is where we are now. And by the way, commodities have really caught up, and yet SPY is only 5% relatively from all-time highs. NASDAQ is 7% off of all-time highs. But the point is, commodities relative to SPX have really, really taken off. Okay, so kind of getting back to this my best guess for a rate spike for the bottom was in August, and we have, as you can see, continued higher. This happens to be a 200 week. That's a 100 week. I use lots of moving averages too, but the point is we did pull back. We got some support for sure. That's actually a 2-bar reversal on a monthly for anyone who's into candlesticks. And we are pushing this 1.567, which happens to be the 10-year level of resistance. Once we get above 1.567 on a weekly close, we're even going higher in yields. So my bond short worked, my gold short worked, they're still working. Yields right now are digesting a whole bunch, but this is obviously very constructive for higher, especially now that we have Fed tapering, and that's coming in starting January. It's gonna look like a black diamond ski slope, because they're really gonna start paring down the rate of purchases of treasuries. So that will further give support to higher interest rates. Why does that matter? Because higher interest rates are de facto tightening, with the whole tech trade being a bond proxy. Now, I know a lot of retail traders don't understand what that means, but it just means that you are really trading this liquidity of loose financial conditions, low interest rates. As soon as they start to tighten, as soon as monetary policy starts to tighten, as soon as the interest rates start to rise, it actually creates pressure on these high-flying tech trades, whether it be big tech in the FANG stocks, right? The Facebook, the Apples, Netflix, Nvidia, Google, Microsoft, Amazon, or the high growth plays, these hyper growth plays that I could go on. There are so many, but and not just the SPACs and such, but there's a lot of pressure that basically will a valuation that will come out of it, and margin contraction that will come out of it, and then equity prices will come out of it and help bring that down. So we really haven't seen that so strongly yet, but that's the baseline concern, right? That we get higher interest rates, and then equity market succumbs to that margin contraction and lower, less leverage that they have, for at the trading desks and all of that good jazz. So basically, this has been a very profitable trade for clients who were positioned not just long the commodity space, but also long the equity market. So now let's just kind of fast forward to September kind of thing. I update in my Slack channel. Again, I got lots of different things that I'm checking out all the time, but here's an example of CRB today. Okay, so and this is CRB on a monthly. So I'm not doing a ratio anymore. It's not SPX to CRB. It's just straight CRB. You can see down here in 2020, we had the COVID crash. Everything was deflated, right? Equities, even gold, the dollar spiked lower before they spiked higher. And oil went negative. That's another whole story. But the point is, once it was an outlier, it had to revert, and it reverted with velocity. This is really multi-decade lows right here. we're talking 1999, 2002, right? Infamous. This rose up into an oil peak. I don't know if anyone remembers, like 140. It was scary. But these are called commodity super cycles. When you see these big impulses higher, we are in one right now. So we have a shortage of everything. So we're going to talk about that in a little bit. But you can also see that I'm tracking what's called rate of change. Rate of change is how fast or slow something moves, and that's just very supported. So when this also triggered above this trend line in my rate of change panel, that also told me we have hot fire flames in commodities. It was basically further support. So now where are we? We're right up here to a level of resistance. It's not a huge level of resistance, but for example, you can see where we broke down here before. We got and then got rejected. Then we broke through it. That was 2002. NASDAQ, if you remember, was really on the floor after the 2000 bust. Okay, well, commodities outperformed then. So then you have, this peak before our recession in the Great Financial Crisis, that's CRB, okay, in the Great Financial Crisis, because that's an outlier that reverts, but it's a lower high. And then we've been trending lower with interest rates until recently, right? Until the COVID crash, the May oil negative print, and now we've had another outlier event where we've exploded higher, above all the moving averages, above the trend lines, above the prior level of concrete or resistance, and here we are up to the next level of resistance. So could we soften and come back in? Absolutely. But big picture, this is over some major trend lines. It's absolutely multi-decade lows. Institutions started coming in and acquiring things because they also realized that regime change was very likely to come into play with higher commodities. And oil as a shock, nat gas as a shock, is not only in low, high demand, but also we have lots of shipping delays that increase the cost of carry and incredible weather patterns that are also putting pressure and just panic buying. So all of this has contributed to the outperformance of commodities since last year, and my theme of clearly things over paper has been in play. So recently, I've also, if you follow me on Twitter, although I don't post any trades on Twitter, they're just for clients, I do kind of do some cheeky cheat sheet kind of things. You'll see inflation equals sticky all the time. So every time I see some kind of an economic data that's released, higher energy prices, higher food prices, higher housing rental prices, which are all contributing factors in CPI, that's inflation, right? And it's sticky. Talking about shipping and container ports being backlogged and container rates being sky high, that's inflation equals sticky. We're not going to have prices come down until the cost of shipping comes down. So I have this long running things over paper now, right? I'm hitting it, over the poor horse is just really, it's already out of the gate. It's been a long time in this lovely rotation. I think it will calm down a little bit, but we still have an energy crisis in Europe. And now we've got, an electricity crisis in China. And shipping is not getting under control yet. And inflation forecasts are not getting under control yet. And in fact, now the Fed is coming in and saying, well, maybe we have inflation as a more durable theme. And CEOs are talking about it in every conference call, and now the narrative with consumers is actually picking up on this, and they're worried about 1970s style stagflation, which is where you have too much money chasing too few goods. And that has also helped our trades for shipping like DSX, which is Diana, and SB. I'll show you those on a chart in a little bit. Coal, BTU, has been a beautiful trade. It's coal right now is in hot demand over in China, and their government is saying whatever it costs to get, their energy supplies. And right now they're also trying to damp down demand, literally tamp down demand by restricting factories from opening. So diminishing the amount of draw on energy resources. So our government today just said they're going to consider minimizing oil exports, and they're going to release more from the oil national reserve. They've said the same thing in China. So they're trying to get a hold of this inflationary spike in energy, because that will directly impact consumer confidence, consumer spending, which impacts GDP. GDP is our economic growth engine model that also gives confidence to investors to buy more stocks. So if you have economic headwinds, basically in the form of an energy crisis, you can actually have an economic crisis. So these particular commodities have been doing extremely well, specifically nat gas. We'll talk about that. Uranium, that actually has been a beautiful trade. Let me just make sure I've got... Hey David, make sure I'm still here with you, or did I mess up and cancel you guys out?
Yeah, I can still see your screen. And
okay, good. One of my screens just went bye-bye. So I can't.
Okay.
All right, so let me go back. You're there, thank you. Literally, one of my screens just went black. So long-running uranium, nat gas, and then select oil plays. So we'll kind of go over these because I think this is the whole support of how do you trade this theme of things over paper when the market is still grinding higher, but components and sectors underneath in the high flying space are either dropping, breadth has been dropping, or small caps, the Russell has been going sideways. So that's an interesting kind of rotation, right? There are pockets of strength within the value and cyclical arena, for sure. Energy. Let me just kind of case in point. Hold on one second. All right, right here. So oil hit a 7-year high. Highest since November 2014, just the other day, that I posted for clients. Literally, despite NASDAQ being down 7%, S&P down over 5%, the broad bond index down 2%, but actually much more. You can see oil prices made up 12% in the same period of the past month. So 1 day relative to performance, energy. 1 week relative performance, energy. 1 month relative performance, energy. And 3 month relative performance, energy. Actually, come the first quarter of the year, energy was the top performing sector. And I kept saying that to clients. It was the outlier last year. It was on the ground. Tech was outperforming. Energy was at the bottom of the sector list, right? It completely turned around. It ran like hot fire flames into January and has been a strong component for those who are positioned in these plays. So that's an example. Now this is really messy technical analysis, but this is the oil low. We had a lot of gyration and volatility. This is October, before the Democratic election and then the blue wave and the Pfizer vaccine. We've been digesting sideways. We still have potential to push higher this is XLE, but the point is, it is also resistance. So what normally happens is we have a pause, a digestion, but right now you can see that if we do get a little bit more liftoff here, and resistance measured move for XLE is right about this 57 level. It's relatively strong compared to SPX. And if we continue to move higher and stay above 80 in crude, WTIC, not talking Brent, but crude, we can, if 80, then 100. And stuff right now is already extremely elevated in the natural gas component, right? I mean, it's 4 times as expensive over in Europe than it is here. But the point, and we're exporting a lot of it. Our LNG market is very robust. But the point is, nat gas has also been coming up in parabolic fashion, digesting a little bit today. It's actually almost reached my monthly price target, and I'll show that to you. The point is, we still have a risk of higher oil and gas prices. And I wrote a little bit something about this called Pivoting on Oil back in March. And I wrote to clients, and I'm going to kind of share this whole thing with you, which was back in March, pivoting on oil, value rotation spike. So why was I interested in this as a theme? Because growth to value is a fabulous tradable thing, right? You short the momentum stocks and you go long the value or cyclical stocks, of which energy is a strong component. I've shown that to you, right? So I track this stuff really, really carefully. In fact, in my January 2021 interview for the year, I said energy was going to be an outperformer. So I'm tracking this stuff pretty closely. Okay, value was oversold. We had a momentum factor rotation into value. Value took off, and then we had the Pfizer vaccine. You know, all kinds of stuff coming to imply that we would have a lot of fiscal spending to also keep individuals spending. Anyway, the point is, we definitely had rates take off. We had that strong reversal from growth into value. A lot of energy took off. So a lot of my stuff back then for the energy trade was very much focused on this rotation theme being durable, but there was a reason for it. We still had higher yields, and that was all because of political, fiscal, monetary, focus was going to be on, inflationary. So what's a really great trade? What's a really great trade to deal with the inflationary impulse of this fiscal spending, government that we have? Oil. So commodities return, energy in particular, are strongly positively correlated with US CPI, making the asset class one of the preferred options for hedging inflation. So I wrote this in March, and we were digesting a big move higher in energy. But now you can see, obviously, it's taking off again recently in the past 3 months. But the point is, it is a fabulous hedge against inflation. Bonds are not serving at all. They're in short mode since August of last year. Gold is not serving as an inflation hedge. It's absolutely not serving as an inflation hedge. The dollar is risk off, and it has stayed bid. And Bitcoin has only recently taken up and, reversed from its prior pullback. It's still to be determined, but it's very excited about, the debt ceiling, okay? I'm not excited about the debt ceiling. It's the first time we would default, and it's a really, really big deal. And that's another reason why commodities are getting bid up. Real assets, much safer than paper assets. So this inflation as a hedge is really important. I can go on, but this, carry, the high cost of carry, this is a little bit more technical than I think some people really care about, but the energy dominates other commodities when CPI is above 2%. Do you know what our CPI is right now? Consumer Price Index? 5.2%. So again, this was written in March, and I saw this coming. I really think that we are going to have another hot print in CPI October 13th. Because of higher rents, because of higher energy, because of higher food, because of all the things that go into CPI. Real or fudged. But the point is, we are now at a rate of inflation above 5%. And the market has been quietly selling underneath the surface since this print for May actually hit. We have been going sideways in small caps. We've been grinding higher in SPY in the Qs, but selling, net selling over net buying has actually been occurring underneath the market. I track that as well. So stimulus, if we get stimulus, right now it's still being debated. Is it 1 trillion? Is it 3.5 trillion? Is it somewhere in between? The point is, stimulus also benefits oil. There's more demand for it. This is direct consumer spending. So these are kind of the macro things, and I'll show you some charts. But I just wanted to kind of give you the backstory of how new regimes can definitely come in from a macro standpoint, and the policies dictate, economics, the relationship of oil as a hedge, not to mention low inventories of nat gas in Europe, low inventory, electricity constraints in China, and low inventories of coal, and they're all substitutes for each other, and how it bids it all up. So coal, nat gas, and oil, uranium, just hot fire flames, and uranium's calmed down a little bit because I contend that they pulled forward that expectation that we had, no uranium outside of, Russia purchases, and we were going to be building more nuclear in India and in China. But that is a long, long implementation. So they pulled forward that expectation and drove up uranium. But anyway, the point is they have been very durable trades, and I go over them a lot. So shipping also is the cause of our inflationary impulse. No question in my mind. The fact that we had the COVID lockdowns, the fact that we still have COVID restrictions in ports, especially in China, deglobalization that's underway, that's obviously very, 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 very slow to unwind. And then you hear about it, LA, container costs, the shipping CEOs are coming in and, cautioning that this is going to take another year. So the point is, shipping is driving an inflationary impulse, and then the low inventories of coal, uranium, nat gas, and not so much oil, but the demand for oil and the inflation hedge nature of oil. So this is what I wrote about the same time, because I think I kind of mentioned that this would be oil shock yet to come when I wrote this. Back in July of last year, and I was also really big into the lumber trade. So for those who are in my trading room for a while, know that I was a lumber bull back in May of last year, and I even had a prediction of 1750 in lumber futures, which had hit before it fell. So I track commodities pretty closely, as you can tell. All right, and I track the dollar. The dollar makes the weather, and the rate of change determines the velocity. So I'm watching the dollar and all of that good stuff, as well as rate spikes. That really matters. So this new regime is important, and I really want to focus on this cautionary sentence that I wrote about oil as the inflation hedge, because at some point it's going to become a headwind, very strong economic headwind. We've already seen growth is getting revised lower. I actually predicted we would have a 0 growth rate 2 months ago for now, and it just got released that we're 1%, but really the real GDP is -1%. Anyway, the point of the matter is we've gone from 6% through all that fiscal printing and treasury shenanigans right down to a 0 growth rate because inflation is so hot. So my point is the warning that I put, which is when this becomes a headwind, when the energy crisis can turn into an economic crisis. We're already above, right, some key levels in this commodity trade. So I'm hoping it will settle down, actually. Anyway, the point is we have, it's going to plan perfectly when bonds roll over, check. Structurally forcing rates to pop, check. We've had that happen. Then oil spikes with the reflation trades. We've definitely had oil and nat gas and coal and, oh my gosh, silicone and popping. while momentum stocks are sold off because they're overvalued relative to value and cause indices to correct. This move could be quicker than folks think as liquidity is challenged in bond sell-off and volatility in the bond market spills over into equities. This really should be volatility in the currency market because it's actually currency volatility that spills over into equities. So what happens is a higher dollar, which is what we are having right now, very strong bid in the dollar, which is, putting pressure on the euro and the yen, etc. That is actually going to spill over into emerging market panic. I don't know if you've noticed, but the Nikkei is down 13%. No, hold on. 12% in the last week and a half, 2 weeks. So that is under pressure. That whole emerging market, space is under pressure with a higher dollar, which puts more pressure on precious metals like gold and silver that don't serve as a hedge. Anyway, this is a concern. So I am also looking for something where is it? Oh, here it is. Okay, so this is basically, I forgot to put this in the right place, but the point is we are short everything. We don't have enough homes. We don't have enough cars. We don't have enough food. We don't have enough inventory. Christmas is going to be slim pickings. So not enough workers, and the Fed, Treasury, and Congress have spent 20% of our GDP in handouts. So lots of paper, not enough things. That's just common sense. So now I have to kind of look and say, what are the charts saying? Because then, of course, I'm putting together trade setups. When is it a low risk entry? When do you need to protect profits? What has changed in the narrative? For example, oil spike is right now being challenged by the government coming in, whether it be China and saying we're going to release reserves, or whether the U.S. say we're going to release reserves, or we're going to limit oil exports, or whatever. God help us if they say price controls, because we know how that worked out in the 1970s. But the point is, these are themes that even cause, the government officials, Fed, all the rest, to now be concerned. And I have a basic, premise that the Fed is behind the curve and will have to play catch up, which is going to be smelled out by the market, and they're going to bring rates up higher even before the Fed announces it. So the interest rate traders are way smarter, way smarter. So they're going to actually drive that whole bond sell-off and rate spike even more as we get more entrenched in this inflationary spiral higher. So right now we have a spike, right? It's manageable, and we don't know if the debt ceiling is going to be managed well, but the point is I'm just focused right now on the commodities. It's safer to be in things than paper. So some of the things have been, like last year, lumber, and right now home builders are absolutely rolling over. That's because things got too expensive and heated, and housing market cooled down. One play in particular was RFP that I had recommended last year, did extremely well. Shipping has been a fabulous theme. Diana, SB, basically that whole basket trading of shipping plays. Agriculture is in digestion mode right now, but that had been fabulous. I think sugar still has farther to go. Uranium, CCJ, there are a lot of other smaller commodity stocks that are faster and more furious, but they're also more volatile. These are the big, that's the big one, and that's the big ETF. Then specific oil companies, for example, XLE is of course the biggest ETF, Exxon the biggest oil and gas company, CPE trades like flat oil, so it can move like Jagger when price moves. SD was a special case. It had declared bankruptcy and wiped out equity bondholders, the whole thing. It was down at $2. I recommended it. It's over $12 now because that was just a particular special case of value. BTU has been a fabulous play. It's up over 200% on a stock basis since I recommended it to clients. And now we just kind of trade around it. And Nat Gas, I mentioned in May, looked like it was going to move higher and have been trading around this as well. These are some of the core themes that I've been on in this, paper to things category. I had liked palladium and platinum last year. I was actually here in Synergy doing a presentation in December on higher palladium and platinum because of the electrification transition. Well, that has since cooled down tremendously, and with it, palladium and platinum. I was definitely bullish uranium, and I presented that case in December, and I was definitely bullish oil, and I presented that case in December. So the narratives can change, right? And right now, these are still pretty strong. And time frames do matter, though. So I just kind of want to explain that a little bit, because for those who might not know it, I'm not a macro trader. I'm not like, I'm chasing. I swing trade, anticipating volatility, and I trend trade. And this is how I define my time frames. It's different for everyone. A chase for me typically it lasts 1 to 3 days, and I use options primarily for everything, unless it's a thin option market, unless it's not tight, or liquid. I don't do options. But the point is, a lot of the stuff that I'm looking at, of course, is. So I'm very much focused on, being in tune with it. So whether it's a trend that typically lasts for several months, and I'm using options 3 to 6 months out, or it's a swing trade, I'm using options 1 to 3 months out, or it's a chase, I'm using options 1 to 3 weeks out. So these are kind of time frames for managing around news, as well, like oil inventories this morning, for example, or it reaches a profit target, and I'm like, ooh, careful, buy some puts against it to protect it, or sell some calls. So basically, that's what we're doing in the live trading room and in my Slack space. And this is something that is not unfamiliar to me. So this is not just a commodity talk of, okay, how did we get here? I hopefully have explained some of that, whether it be the rate, impulse, higher yields, or things over paper, or inflation is sticky. The concerns that I have right now, that higher equities, trigger the selling of bonds, which has happened, and this whole inflation spike is going to trigger volatility. An energy crisis will trigger volatility in an economic one. So we have lots of room here to fall. I mentioned this because I'm looking for volatility right now of big size, right? Not little ones that are going to pull back for like a 5%, which we've had, which I actually timed on September 8th. So I felt we were going to pull back into the FOMC. We had a nice 2-week pullback. We bounced, and then we pulled back some more. And I am looking for something out of DC to give us the support to move higher. So meaning we need, that debt ceiling resolved. And it's a 50-50 chance right now. That's not great odds. Infrastructure, reconciliation for, the fiscal stimulus that's being debated. Point is, we don't have anything resolved. And until we do, we're at risk of some outsized volatility. So that's my job. And you can see this is absolutely my job. I look for volatility. Otherwise, I'm looking for sector rotation. And my mantra is simple. In lieu of sector rotation, we will have volatility. So right now, I'm expecting some outsized volatility. We haven't triggered yet. It wouldn't be a surprise if debt ceiling is the trigger, but my point is, it could also be an oil spike. It could also be Fed missteps, but the point is we're getting to a place where the highs in the stock market, we could absolutely turn around and move strongly higher on the rumor of debt ceiling being resolved and lots of fiscal coming our way, and then we actually get it and we sell off on the news first part of the new year. So I'm not calling it for tomorrow here. I'm just saying this is my thing, is to time market turns and inflection points, and we are at it. So that's basically, my focus, and I wanted to show a few other charts and then see if that helps kind of explain or answer some questions also in regards to bonds, or we have NFP, non-farm payrolls coming up in on Friday. We'll see how that delivers. Right now we had ADP, which was very strong, should be bullish, but I think everything right now is focused on the debt ceiling. But here's, for example, VIX stacked. And this is VIX, by the way. We have broken above this wedge. I think you can chart VIX very easily. This happens to be midterm futures VIX, which is called SVXY. Forgot to label it. That has broken down, which is market bearish. And this is SPX. That has broken down. That's market bearish. I have other kind of volatility work that I do that is showing this intonation of higher VIX, the potential for backwardation coming in future weeks. We're not there yet, but basically I'm seeing lots of breadth indicators as well. Let me just show you that because it's fabulous, and I don't know when we're going to trigger it, but hold on. We got earnings season coming up. That's another one that we, excited to see how conference calls go regarding shipping delays and inventory and passing on prices to consumers. But here's an intermarket tell I wanted to share as well that is, very worrisome, which is this NYSE summation index I have tracked for the past, since 2013. We've had a few little red blips, right? So some of these are pullbacks, some of these are crashes, some of these are, that's COVID, for example. They've been pretty good at timing corrections, okay? We went negative. This is 9 days ago, but the point is, when this went negative, I alerted clients to be on the lookout. So this is still in play. We are still intonating lower. We have not turned and moved higher. That's my tell to let clients know it's more safe. Does that make sense? So since 2013, this indicator has triggered 10 times, and all the other times resulted in some kind of pullback, correction, or crash. So another reason why I think commodities are getting the parabolic treatment is there's some genuine fear around here. So some of these trend plays, let me just kind of show you on a chart. All right. Let's do coal. Okay, so this particular action, if you will, I picked up in May, and I wanted to show you technically. So I've given you lots of macro, but I haven't really showed any micro, which is the technical stuff. So when we started, by the way, this is all of 2020 and the first part of 2021. When we actually triggered around this $5 mark, I said, ooh, guess what? That looks like the auction of buyers and sellers is going to reward the buyers. They've absorbed the sellers because now we actually have price in BTU, which is coal, above the 10-week, and now we've broken above, this actually is a monthly level. That's very bullish. We hit the 100-week, we came back, but we were supported by this 10-week. We moved higher, it was another shallow pullback. Another shallow pullback. You can see how the 10-week stayed supported. And then recently a client asked me, because we actually reached my price target, I gave 1877 as the price target, and said it would not surprise me, because every time a stock goes up to a major moving average, whether it be the 10-week, the 50, the 100, the 200, I don't care, it typically digests. Sometimes it pulls back sharply like BTU did, or it kind of digests for a long time, and I'll show you like XLE did. So this had a dramatic pull down, and usually I'm like a 10-week girl. Above is bullish, below is bearish on a close. And a client said, are you still bullish? And I said, yes, because the macro case hadn't changed. There was some very big whales that came in and sold and pushed that price down, but ultimately it went right back up. Now we're not out of the blue here. We got to get back above 1877 to move higher, but the trend is not busted. So this has literally been in play for a while. DSX was another one. This is shipping, same idea. Loved how this moved, right? Absorbed the sellers, and then it got up to the 200, had this big impulse, and this is where I was recommending it, was in the 3 area. It has taken a little while. It's had some bigger volatility moves, but it's still in play. Same thing with SB, which is another, shipping play. It's gone right up to the fib level, digested. Anything above the 10-week on a close is very bullish. So that's just an example. Natural gas, and the underlying commodity for some retail is very hard to play. It requires a lot of margin and a lot of familiarity with commodity trading, futures trading, which is not a comfort level. So I'm going to use UNG for nat gas. This was actually recommended in May, and I'm going to just kind of show you first and foremost why. This trend line triggered, and it wasn't until it was about $10, $10.50 actually, that I recommended UNG. I was excited about it because of this trend line, just to see where it was going to go. First was the 50, it pulled back, it broke out, it pulled back, but again, this is the 10-week. Broke out, pulled back, and then it cleared a very important level, for me anyway, which was this trend line. And I'm like, this thing is going to go parabolic. And I actually had given a price target. It was a 480, which is the underlying. And then I said, if it hits 5, it's going to 7, which it did, practically like a few pennies off. So this is where we're at right now. We literally came up and tested the 200-day, and we're pulling back a little bit, which is not a surprise. And I actually had also warned here when we got up to this level that we would likely pull back, and this was my level that I gave, 1677. Happens to also be the 21. So again, I'm using macro as a backdrop. I'm fascinated with what's going on in Europe. I'm watching the underlying and all of the inflation and all the commodity prints and the inventories while I'm looking at this chart. And I'm saying this is going to get supported at 1677, and it did. So the underlying is pushing up against 7. It pulls back. It's got room. It could still come all the way back down, honestly, to the 10-week, to 17.5, and it would still be bullish. Now, this happened back in 2019 before it gave up the ghost. Now it's got the energy. It wouldn't surprise me if it digests here. It could be weeks. But this is monthly resistance, which has been my price target before it does a pause and digestion, before it does kind of this type of thing, left shoulder, if you're kind of thinking about it that way. But basically, this has been a phenomenal outperformer since 1050, and the underlying, like I said, hitting like close to 7. So nat gas, coal has been beautiful. The shipping has been beautiful. Gold has not. Gold is absolutely not the same creature, and it has been in a solid downtrend since August. And I literally printed my short call for a 15 to 25% pullback in gold. I put that on August 11th. This was 15%. We bounced very strongly, made a lower high, and now we're back to this 100 week. I think it's going to come down to 154.5, which is quarterly support. And then I think it'll be a fabulous trade in the new year. But for right now, I don't trust it for any more than a bounce. For a counter trend bounce. I am wrong if this turns into an inverse head and shoulders, but I am not interested in gold unless it gets above GLD, which I can do the comparison with continuous contract, but I'm just kind of showing it because I think this will be easier. Above 174 is very bullish. In the meantime, I think this is going to fade down to 154. We came close, and here's the 200, right? So anyway, precious metals. And I'm going to use UUP, not the dollar, just because for charting purposes, it's pretty clean. This has been really well bid. Right now we have a high of 25.35 last week and 25.35 this week. if this proves to be a 2-bar reversal, this is very bearish. Dollar will come lower. And that's going to help precious metals, industrial metals, the raw materials, the energy, oil, all of that stuff. It's to be determined. It could, for me right now, anything above this red trend line is bullish, and it's going to move higher. So I'm still a dollar bull, and I'm precious metals short, and I believe wood is going to be better later, lumber later. Palladium and platinum, they have not broken their long-term trends, but they're definitely weak. Copper, steel, the rest, home building got hit, economic growth got hit. They're absolutely proxies for that, much more so than inflation. And the focus right now is on the energy crisis, and it is very tradable, but know your time frames. And when things get very, very spiky, for example, like a nat gas, or let me do this one. Hold on, let me just show you something real quick. I can't show it to you. I can't find it. Dang it. All right, anyway, when you see a parabola that's extremely elevated, here it is. There it is. There we go. I'll show it to you. Here it is. I found it. So here's my theme on parabolas, and they're important because this commodity push is, as I showed you first and foremost in that CRB chart, pushing against some resistance. It can absolutely come down and digest and all kinds of things, but I'm not seeing it falling apart. Inflation is way too sticky. We're in short supply of everything. But when you see a parabola like this just happens to be natural gas over in Europe, this is crazy. This is basically trapped longs. And trapped longs will trigger volatility. Volatility will trigger a liquidation risk. So that's what happens with parabolas. They are trapped longs. So just be careful. Don't, personally, I said this to clients, don't try and short natural gas, really, because it went far higher than reasonable. And then you have this kind of, lose your head, but you have to time that top perfectly. So anyway, that's my warning on trying to short parabolas. They are trapped longs trying to get out, and you have this panic buying, and then the last ones in freak out. So anyway, let me know if you have any questions. I am definitely here for engagement in my live trading room, and post all of my macro, intermarket, fundamental, quant, sentiment, and technical analysis in the form of charts and trade setups in my live trading room across all assets. Commodities are just one. I do crypto, bonds, currencies, stocks, you name it. Emerging markets, US, doesn't matter. So that's my thing. I have 2 ways that you can get this information for those who are interested. I have a Big Ideas membership. It gives you the best of my trend trading ideas, okay? Not the chases and the swings, but the trend trading ideas.
Samantha, sorry.
No worries. And my
to-
fishing club membership. That's it. The end.
All right. Thanks, Samantha.
I wish you all a great rest of, the start of autumn.